Welcome to the deep dive. We're not just skimming the surface today, we're going deep into the source documents. Our focus, it's Colgate-Palmolive India. We've got the outcomes from their board meeting on October 23rd, 2025. And this isn't only about the Q2 numbers. We're looking at, well, everything dividends, key people changes, and a really important update to their governance policy, stuff that matters for transparency.
That's right. So our mission really is to pull apart these unaudited results for the quarter and a half year ending September 30th, 2025. But just looking at the numbers, that misses the real story. There's a huge regulatory shift that completely changed the game for their sales this quarter. Understanding that context is vital.
Okay, let's unpack this then, starting with the financials. At first glance, the headlines look a bit rough. If you compare Q2 this year, ending September 30, 2025, with the same quarter last year, net sales came in at what, RS 4,507 crore?
Correct. And last year it was RS 1,609 crore.
So yeah, that's a drop, a 6.3% decline in net sales year on year.
That 6.3% figure, yeah, that jumps out. That's sales net of GST. But, and this is really important, you need to look at the previous quarter too.
Okay.
Sequentially, so comparing Q2 to Q1 of this financial year, Q1 sales were ours, 1,421 crore.
So from Q1 to Q2.
They actually grew by 6.1%. So a drop year on year, but decent growth quarter on quarter. That kind of volatility usually points to something external happening.
Right, not just a simple slowdown in business.
Yeah.
So what is the external factor here? How do we square that sequential growth, but a year-on-year fall?
It boils down to one major thing,
Yeah.
GST, the goods and services tax. The rate on their entire oral care range was slashed
Slashed how much?
dramatically, from 18% right down to 5%.
Wow, okay. That's huge.
It is. And Colgate passed that full 13% tax benefit straight to the consumer. Great for shoppers, obviously, but it immediately impacts the top-line revenue number they report.
Okay. Now, the company's statement mentioned a transitory disruption at distributors and retailers. That sounds maybe a bit soft for a 6.3% revenue hit.
Well, transitory disruption is the official language. But you're right to question it. Was it just disruption, or was it also a conscious strategic decision?
Meaning they chose to take the revenue hit.
I think so, yes. Passing on the full GST cut makes their products instantly cheaper on the shelf. They welcome the lower tax because it should boost volume in the long run, but getting those lower prices through the whole system, distributors, retailers, that causes short-term pain. Inventory adjustments, pricing updates, that's the disruption.
So they sacrificed immediate revenue to make their products more competitive, probably against smaller players who might not pass on the full saving.
Exactly. It's a bet on regaining that lost revenue through higher sales volumes down the line, defending market share.
Okay, that reframes that 6.3% decline significantly. It's a strategic move, not necessarily a sign of weakness. So how did this affect the bottom line, the profit? Net profit after tax, PAT, was RS 328 crore for the quarter. That's down from RS 395 crore last year.
Right, and on the surface, that looks like a big drop too, around 17%. But again, context is absolutely key here.
Let me guess. Something unusual in the comparison quarter.
You got it. The Q2 number from last year, ending September 30, 2024, included a significant one-off item.
Which was?
It was other income of about Rs, 56.46 crore. Specifically, interest they earned on a tax refund. That wasn't operational profit.
Okay. So a one-time boost last year makes this year's comparison look worse. If we take that out, normalize the numbers.
Exactly. That's what analysts do, look at the underlying normalized profit when you strip out that tax refund interest from last year's base.
What does the drop look like then?
Much smaller. The P decline narrows to just 7.2%. So the core business held up pretty well, considering that big GST impact on revenue.
That's a critical piece of information. A 7.2% adjusted drop is very different from 17%. And it sounds like they weren't just cutting costs to protect profit either. They kept spending.
Definitely. Look at their advertising spend for the quarter Rs, 225 crore roughly. That's a serious commitment to brand building, even with the revenue headwinds.
Right. Investing for that volume recovery you mentioned.
Precisely. They're focused on growth, driving volume, and also rewarding their shareholders.
Yes, let's talk about that, because alongside navigating this GST change, they also announced a dividend.
A pretty substantial one, too. The first interim dividend for the financial year 2025-26.
How much?
It's Rs 24 per equity share. The face value is just Re1, so that's quite generous.
And the total payout must be significant.
It is. Adds up to about Rs 653 crore in total. That's a strong signal of confidence from the board about future prospects, wouldn't you say?
Absolutely. You don't commit over 650 crore if you think things are genuinely weak. The payment date is set for November 19th, 2025.
Right, with the record date being November 3rd. So they're clearly betting that the GST strategy pays off fairly quickly.
And what are they doing on the product front to drive that? The CEO, Ms. Prabha Narasimhan, mentioned innovation.
Yeah, there seems to be a clear two-pronged approach. First, push the premium end of the market. Products like their Colgate Visible White-Purple toothpaste are apparently leading growth in that premium segment. And they've launched new things, like the Palmolive Moments body wash range.
What's special about that?
They're highlighting things like 100% natural extracts, patented fragrance technology, features that justify a higher price point and appeal to a different consumer base. Better margins there, too.
Makes sense. Premiumization. But you can't forget the core, right? Especially for a company like Colgate.
Absolutely not, and they aren't. They're putting serious marketing muscle behind their flagship brand, Colgate Strong Teeth, or CST.
With that new campaign.
A cavity-proof campaign, yes. They're really emphasizing the tech behind it, the arginine plus calcium boost formula. The message is about 24-hour anti-cavity protection.
So it's innovate at the top end, but strongly reinforce the core trusted brand.
That seems to be the strategy. Keep the base strong while exploring higher margin growth areas.
Okay, let's shift gears a bit now, away from financials and products and towards the corporate structure itself. The board meeting also covered governance and personnel changes.
Right, equally important for long-term stability and market trust. There was a key change in personnel.
Who's involved?
Mr. Surender Sharma, who was the whole-time director for legal and also the company's secretary and compliance officer, finished his term on October 27th, 2025.
So a departure. And who's stepping into that compliance officer role? That's a critical position.
It is. The board appointed Mr. Jaikishan Shah as the new compliance officer, effective October 28th.
Mr. Jaikishan Shah. What's his background? Does he bring relevant experience?
Oh, definitely. He seems very well qualified. He's an associate member of the Institute of Company Secretaries of India, ICSI. Got over 14 years of experience.
Degrees.
Law and commerce. And his previous roles are quite notable. He was Deputy Company Secretary at Castrol, India.
Castrol, okay.
And before that, 12 years with Pfizer Limited.
Wow, Pfizer and Castrol, that's serious corporate experience, especially in listed companies. Bringing in someone like that maybe signals an intent to be even more rigorous on compliance.
It certainly suggests they value strong experience in navigating SEBI regulations and maintaining high standards. It ensures continuity and reinforces their commitment to good governance.
And speaking of governance, that ties directly into the other big item, the updated policy on determining materiality.
Yes, the policy on determination of materiality of event or information. This is basically their internal rulebook for deciding what needs to be told to the stock exchanges and when.
Why revise it now?
It's likely to ensure it's perfectly aligned with the latest SEBI regulations, the listing obligations and disclosure requirements, or LDR. These things evolve. The goal is market trust through clear, objective standards for disclosure.
So how does this revised policy work? What makes something material enough to require disclosure?
It breaks down into two main types of checks. First, some things are mandatory disclosures, meaning events listed in Para A of Schedule 3 of the SEBI rules. Think major restructurings, regulatory actions against the company, things like that. Those have to be disclosed, regardless of the financial value involved. They're just inherently material. Then, for everything else which falls under Para B, there's a materiality test.
Okay, and how does that test work? Is it just subjective?
No, it's designed to be objective, primarily based on financial impact. It uses specific quantitative thresholds.
Right, let's get into those. What are the numbers? An investor needs to know the trigger points.
Absolutely. An event under Para B needs disclosing if it crosses the lowest of three thresholds. This catches things even if they only trip one wire.
Okay, threshold 1.
2% of turnover, based on the last audited consolidated financials. So if turnover was, say, 6,000 crore, the trigger is 120 crore.
Got it. 2% of turnover. What's number 2?
2% of net worth, again, using the last audited consolidated figures.
Okay, turnover or net worth. And the third?
This one's based on profit. It's 5% of the average absolute value of profit or loss after tax, calculated over the last 3 audited consolidated financial years.
Using a 3-year average smooths out any single weird year for profit.
Precisely. It gives a more stable baseline for judging impact. These quantitative tests ensure only genuinely significant financial events trigger a mandatory disclosure.
But what about things that aren't easily quantifiable? Like, I don't know, a potential reputational issue that hasn't hit the numbers yet but could spook the market.
That's covered by the qualitative test, and this test always applies, alongside the quantitative ones.
How does the qualitative test work?
It asks, is the omission of this information likely to cause a discontinuity or alteration of information already out there? Or maybe more importantly, would its omission likely lead to a significant market reaction if it came out later?
I see. So it's a safety net for non-financial but potentially market-moving information.
Exactly. It covers those situations where the numbers might not trigger yet, but the news itself is clearly material to investors.
Makes sense. Now, who inside the company actually makes the call on whether something meets these tests? Who holds the authority?
The policy is very clear. It designates the key managerial personnel, the KMP,
Specifically.
the managing director, the chief financial officer, and the company's secretary and compliance officer, so the newly appointed Mr. Shah. They are jointly and severally responsible for determining materiality and ensuring disclosure happens.
Jointly and severally, meaning any one of them can make the call and they are all accountable.
Correct. It ensures there's always someone empowered to act quickly.
And speed is crucial here. What about disclosure timelines? How fast do they have to get this information out?
Very fast. The policy reflects SEBI's strict timelines. If a material decision is made during a board meeting, say, it needs to be disclosed to the exchanges within 30 minutes of the meeting ending, assuming it's during market hours.
30 minutes. That's tight.
It is. And for events that happen internally, not in a board meeting, like a major factory issue, the disclosure timeline is typically within 12 hours of the event occurring or becoming known internally. Speed is paramount for market fairness.
Okay, let's try and pull this all together. Quick recap of the main takeaways from this deep dive into Colgate-Palmolive India. The Q2 results, they definitely show the immediate hit from that big GST rate cut, but it looks like a strategic move passing savings to consumers.
Right, a calculated sacrifice on the top line. But the underlying business performance, when you adjust for that one-off tax refund interest last year, was actually quite resilient.
Which allowed them to keep investing heavily in their brands.
And also declare that significant interim dividend, signaling confidence.
And at the same time, they're strengthening the foundations, bringing in an experienced compliance officer like Mr. Shah, and formalizing this very clear, detailed policy on market materiality.
It paints a picture of a company navigating a major external change strategically, focusing on long-term volume and brand strength, while also tightening up its governance and compliance framework.
Which brings us to a final thought, something for you, the listener, to consider. Given that Colgate is making these big strategic bets, deliberately accepting lower revenue now via the GST pass-through, spending heavily on advertising things that are about long-term positioning, do you think these new, quite specific quantitative materiality thresholds, like 2% of turnover or 5% of average profit, are actually sensitive enough? Will they capture the strategic significance of these moves fast enough for investors in real time? Or is there a potential lag between long-term strategy and short-term disclosure triggers?
Yeah.
Something to mull over.